Portfolio management services, or PMS, have become quite popular in recent years due to several factors like increasing income levels, ease of getting information owing to the social media and internet, and maybe to an extent for the need of diversification and enhanced returns. In fact, as per a sector study done by PMS Bazaar recently, portfolio management services and alternate investment services, or AIFs, have experienced significant growth in the last few years, and this industry is estimated to grow to an extent of 26% CAGR to 43 lakhs crore by 2028. For investors who have a big investment ticket size to invest in, it seems PMS may be a good option to invest as they prefer a wide range of customized solutions. But what about a new or a novice investor? Should a novice or a new investor choose a PMS or a mutual fund product, which can offer them better returns with time, more flexibility, and of course, being more tax efficient? To help us understand what should be an ideal investment solution for most of the investors like us, in this episode of One Step Ahead show by DSP Mutual Fund, we have with us today Mr. Gajendra Kothari, an investment veteran who has an experience of more than 2 decades in both Indian and overseas capital markets. Mr. Kothari is the Managing Director and Chief Executive Officer at Etica Wealth Private Limited. He is a CFA and has also pursued his MBA in Marketing and Finance in IMI New Delhi. He is passionate about creating financial awareness and empowerment amongst the youth of India and has done several programs across India to do that. He has made several live appearances on premier business channels like CNBC TV 18, ET Now, etc., and has also been interviewed and quoted by both international and domestic print media like Financial Times UK, Economic Times, Times of India, Live Mint, etc. It's great to have you in the show, Mr. Gajendra. Welcome to this episode.
Thank you, Sumana, for that generous introduction. Absolutely delighted. Thank you, DSP, for giving me this opportunity. And I really look forward to this engaging conversation.
Absolutely, Mr. Gajendra. But before we start this conversation, request all our viewers to share their questions in the comment section and we shall get back to you at the earliest. So, Mr. Kothari, we would want to know more about you first and your wealth management journey. What is the story behind Etica Wealth Private Limited?
Sure, Sumana. So, I was very lucky that when I passed out from my campus in 2004, I was recruited by UTI Mutual Fund and I landed up at the Mumbai head office. And the first role they gave me was to a branch in UTI Juhu, where on first day, right from first day, I started meeting investors. And that's when I realized that a lot of investors in India have no financial literacy. They would come with a lot of documents. That time, those unit certificates were there. They would bring all those certificates and tell that their parents have invested, but they have no clue about this. Could I help them guide through this maze? And this is when I realized that my interest lies in kind of interacting with end customers to explain them products in a simple way and help them achieve their financial goals. So that was when I thought that someday I would want to start my own firm. But in 2004, 5, 6, India was going through a bull market, and we saw a lot of mis-selling also happening in the financial services industry, be it insurance, where ULIPs were rampantly being sold, or mutual fund NFOs were there. So I didn't like the approach. I thought this was more sales-based kind of approach. I always wanted investors to buy the products which are suitable for them. But then I didn't have much experience, so I worked with AMC UTI, the only AMC I worked there for 7 years. I happened to be in London for 3 years looking after their European operations. And there also I realized that the situation is very similar in UK as well. Most people do not have much idea about the investments. So I decided to come back to India in 2009, and that's when we started Etica Wealth in 2009. The whole idea of starting Etica was that Etica, if you see the word, it's a Portuguese and Spanish word. It means ethics in that language. And I said, whatever we are going to do, ethics before everything has to be the mantra. Okay. And we are going to do investments for our client that we have done for our own family's money with, So we are going to show our portfolio to all our clients in all the IPs we do, and we'll tell investors, this is what I've been doing with my money, and I'm recommending the same to you. So either we swim together or sink together. If markets tank and if things don't go well, I should also feel that pain. So this has been the genesis of Etica. God has been kind. It's been 14 years. It's been a wonderful journey, I would say. And so today we manage upwards of 2,000 crores of our clients' assets. And we feel really happy that we're doing some meaningful work. We are adding a lot of value to our clients' lives, making sure that their money work equally hard for them. And finally, our objective is, can we help them achieve their financial goals? And I've always believed in life that 95% of the problems in our lives are somewhere connected with money, right? And if I can help solve this puzzle in a client's lives, I would have done a decent job, over the years. That's been our mantra for last 14 years. And we look forward to this journey even for the next 2, 3 decades going forward.
Absolutely, Gajendra. I think you have highlighted a very important point here, that majority of the problems that we face in our life is due to money, and probably that's where we really need to ensure that we are very much aware of where are we investing our precious money. So Gajendra, you've spoken about your journey of 14 years with Etica, and you also mentioned that you have been managing your a big client profile. Would you also tell us a little bit about the client profile that you cater to as a personal finance expert? How many investors do you manage? And also a little bit about your team. How big is the team?
Yeah. So from day one, I was very clear that we don't want to manage money for ultra HNI people, because there are, within this segment, there's so much competition, and each ultra HNI net worth. And when I say ultra HNI net worth, like it's 10 crores and upwards, they're already kind of swarmed by a lot of financial advisors, wealth managers, boutique firms. So we didn't want it to be in that space. We always wanted to serve mass affluent segment, somebody who brings 25 lakh, 20 lakh or 50 lakh on day one, and we help them grow wealth over a period. I still remember this wonderful line from Parag Parekh, late Parag Parekh. He used to say, we don't chase HNIs, we create them. And the kind of happiness you feel when you create someone, an HNI over the years, being a partner with him or her in this journey, that's a super feeling. So we cater to somewhere between retail to HNI mass affluent segment, and help them become HNIs. So in the last 14 years, we are managing today 2,000 families, and individual clients would be around 7,000 plus.
Wow, that's a big number.
Yeah. And this couldn't have been possible by myself alone. We are very ably supported by a 36 people team across India. So we have a main office in Mumbai, plus we have branch office in Assam, which is from where I come, and Calcutta and Delhi. So of course, in Assam and Calcutta, it's more of a retail segment. In Mumbai, predominantly, it's a mass affluent segment. And that's been our philosophy from day one. And we would like to grow in this segment only. Because this is a segment we have seen, Sumana, that many of our clients were earlier clients of banks, private banks, and somewhere they were missold because of the targets in the system, incentives
Absolutely.
in the industry we see.
Mhm.
And they wanted somebody who can really guide them through this maze, without making them feel overwhelmed, explain products or stuff in a simple way, are able to address queries 24/7, can handle them through volatility in the market. So all of this has been our philosophy, and I'm happy to share, Sumana, that 95% of our clients have been with us for a long time, but I would rather now say lifetime, because it's more of now a family relationships with your investors. They don't just consider you as your financial advisor; they consider you as your well-wisher, a part of extended family, and they tell their all other members in the family that if something were to happen to them, Etica Wealth and Gajendra Kothari is the person to go, without even any doubt. So we feel, I mean, it's a big responsibility on our shoulders, and that is why
Absolutely.
we have to be always cautious that nothing should go wrong with our clients' money, at any time in the future.
Right. I think that's an inspiring story that you said, and your passion actually shows in your work, your passion of financial awareness, and the pursuit that you are doing to ensure that your clients are happy about the services and they make the right choices. Now, coming to the choices, we would also want to know what processes would you follow to recommend investment solutions to your clients, and what kind of funds do you recommend to your investors to start their financial planning journey?
Superb question, Sumana. So most of the clients we have acquired in the last 14 years have come through our IAPs, investment awareness programs.
Mhm.
We believe if somebody has attended our seminar for 2 hours, 3 hours, and sat through the entire thing, and after the seminar, if that person contacts us, which means he's already clear about what he or she wants. And in that IAP, we show our entire journey, our own personal journey, that how I have invested my own money, for different goals, what philosophy I follow, what mistakes I made. Okay, all of this we show in a very transparent way. Okay, and when then people, they are able to connect to my story, and then they say, okay, can you help, plan my journey as well in the similar fashion? So that's how we start. Of course, we tell them first they have to take care of the insurance parts because protection is very important. So life insurance or health insurance has to be in place before they begin their first step in investment journey. And even when we start the investment journey, we try to be a little conservative on day one because we don't know the investor very well. Investor doesn't know us even, equally well. So there is a process of building trust over a period of time. So we don't want to be very aggressive on day one. We give them reasonable expectations that, okay, over a long term, you may expect 10 to 12% kind of returns. We try to invest them in simple products. So, if somebody has been an FD investor, we may want to bring them to debt funds or maybe equity savings funds kind of category. And then slowly, and if their horizon is like 5 years and above, then we kind of try and advise them to invest in diversified equity funds. So our approach is entirely buy and hold for long term. We don't want to churn as too many times. So the idea is, can we remain invested for 5, 10, 15 years and enjoy that power of compounding? And I do this through demonstrating my own portfolio where I have personally been invested in almost all the funds for 10 plus years, 10, 15 years. And when clients see the results that, yes, it has been up and down, but overall the trend line has been very, very positive. And, so far in the last 14 years, markets have been kind and the portfolios have been able to earn 14, 15% return. But even then, we say that your expectation should not be beyond 12%. Anything beyond 12%, if you've got so far, it's your luck, it's bonus. There is nothing due to me. Markets have rewarded us, and markets may take back these gains also. So you should be prepared. So that's how we always believe that we should under promise and then over deliver to create happy experiences, because our business is all about expectation management. If you on day one, if you tell your clients that, okay, you might expect 18%, and if they end up getting 15% also, then they'll not be happy.
Right.
So you have to be very careful what you promise, and you should stick to this at all point of time.
Absolutely, Gajendraji. I think, especially when it comes to equity products, our expectations just go haywire. And when we suddenly see a lot of, returns coming from the funds, like especially when I too personally do a lot of financial wellness sessions or IAPs with our investors. And, one thing that is generally being discussed is what kind of returns should I expect? They want returns, but they don't want to commit that time. And I think that's a big expectation mismanagement. And probably you are doing the right way. You're just setting the right example by showing your own portfolio as well as to how that has performed with the time commitment that you had given. So talking about the journey of equity, a lot of our investors often say that PMS recently has become quite popular an investment option to get into equity markets. Can you tell our audience what exactly is a portfolio management service or PMS, and how are they different from the general mutual fund schemes structurally? How many stocks would typically a equity mutual fund portfolio have vis-a-vis a PMS?
Sure. So as you rightly mentioned, over the last 4 years since the onset of COVID, markets have been going one way up, and that has, that has been one of the primary reason why investors' risk profile has also gone up, and they have latched on to PMS as a vehicle. Generally, PMS and mutual funds are both managed portfolios, which means there is a fund manager who is managing the portfolios. So by construct and design, it is the same. But just to give you more easy example or analogy, treat this as a comparison between a public bus and a private vehicle. Mutual fund is more like a public transportation system where the bus has a defined journey. It will go from point A to point B. It won't deviate, and there are various scheduled stops in between. Investors, the passengers can get in and get out from that bus at any point of time. The bus is driven by a very experienced driver, and the charges are very reasonable. And generally, public transport buses are very well regulated. In sense, if I take the example of best buses in Mumbai, it's a very synchronized system, and it's been there for last 50, 100 years. Whereas a PMS is more like your private vehicle, maybe Uber, Ola, or your personal vehicle, where you can, board whenever you want, you can get out whenever you want. It's more expensive. Of course, you have your driver there also, a professional again. But that's more expensive, right? But you can go to the destination where you want end to end. So that's the main difference between a PMS and a mutual fund. Mutual fund generally is more suitable for first-time investors who have come, and PMS can have many different varieties. In mutual funds, we have seen, from SEBI, the minimum stocks in a portfolio should be at least 30 to begin with, and then it can go to 50, 60. Usually, the portfolio sizes are between 50 to 60 stocks, but it can go up to 100 stocks, 150 stocks also. In PMS, there is no such restrictions. The rules are a little more relaxed because that's more meant for high net worth individuals or more empowered investors. There, the fund manager can have as less as 10 stocks in the portfolio, a concentrated portfolio. Generally, we have seen in PMSs, they have between 20 to 30 stocks. So it's more concentrated bet compared to a mutual fund. They have many different themes which a normal mutual fund may not have. So this is a broad difference between a PMS and a mutual fund.
Right. So what we could understand is, the entire proposition can be a little more expensive as compared to a general mutual fund scheme. And also the portfolio is much more concentrated. So Gajendra, how does a PMS then typically work? I mean, is the investment strategy different than a mutual fund strategy? Also, what is the minimum investment amount that is needed for an average investor to enter a PMS scheme vis-a-vis a mutual fund scheme?
Sure. So as I mentioned, PMS vehicle can have very different themes, but if you see the kind of PMS available in the market, 70% of the investment strategies are very similar to mutual funds. So many PMSs are large cap funds or multi cap or small and mid cap as well, which even mutual funds offer. But at times, PMS can offer a very, very concentrated theme, like just I said, 10 stock banking portfolio, which you will not find in mutual fund, right? Or a green fund portfolio, which presently we may not have in mutual funds. So they may have this very, very differentiated themes, but that again, maybe 10 or 20% of the mutual PMSs that would offer. Mutual funds can't offer these products because they are very highly regulated and they have to follow the rules and regulations laid down by SEBI. And because PMSs are more personalized and customized, that's why the minimum ticket size is 50 lakhs as per the regulation. And there are many PMSs which have now increased it to 1 CR, as the minimum ticket size. Okay, they can do so. Whereas in mutual funds, even if you have 100 rupees or 500 rupees, you can start your SIP as low as 100 rupees, or you can start your lump sum investment with 500 rupees as the minimum. So it's meant for all kind of people, but PMS for certain is meant for very empowered investors, informed investors who know what risk they are getting into, and I mean, they have to stick for longer time compared to mutual funds because getting in and out of PMS is not as easy as it is in a mutual fund.
Right. So yeah, 50 lakhs or a 1 CR is a big portfolio to start with, compared to just a mere few hundred rupees for mutual funds. And you also mentioned the most popular way of investing in mutual funds, which are SIPs. I'm curious, is SIP possible in PMS as well? And also one more thing, we thought to ask you is, why is this entry level in PMS so high as compared to a mutual fund? Is there a specific reason for that?
Yeah, there is a specific reason because in PMS, the stocks are finally held in your name. The portfolio manager is just managing the equity portfolio on your behalf. You are the beneficiary, final beneficiary owner. And that's why each customer has to open a demat account, which is not required in a mutual fund. Mutual fund, in 5 minutes, you can set up your account online and you can start investing from anywhere in the world. But when PMS, you'll have to sign a lot of documentations because demat account has to be open. In some cases, at least for NRIs, you have to open a separate bank account also for them, right? So it is fairly lengthy process, and that is why the minimum ticket size 50 lakhs has to be there to ensure efficiencies come in. Because if we start getting clients at 5 lakh, 10 lakh, it may not really work. And because they offer little more differentiated portfolio and more concentrated, the kind of investors the regulator want to come into PMS would be far different, than people come in mutual funds. At least in PMS, it is assumed that the investors have understood the risk factors in a PMS. The risk factors can be liquidity of stocks because it's a highly concentrated portfolio. It can go to any length, any small cap, micro cap, illiquid stocks kind of thing also. But in mutual funds, these things may not be possible. So that is why the ticket size is much higher. Whereas mutual funds, I would say getting in and out is pretty easy. You can get out in one day also, and setting up or even withdrawals are far more simpler.
Right. And you mentioned that that entire tranche of the initial investment amount, can that be done in tranches rather than just as a lump sum investment, just like what we do in SIPs in mutual funds?
So minimum 50 lakhs has to be there on day one. It
Okay.
cannot go below that. But if suppose if you're investing 1 CR, 50 lakhs has to go lump sum. You can put in a liquid fund in a PMS and can do an STP, but the minimum corpus on day one has to be 50 lakhs. And then you can do either systematic transfer plan into the stock portfolio, or if you have money in the bank account every month, you can do an SIP also in a PMS. But 50 lakhs has to be on day one as per the regulation.
Right. So, besides this minimum investment amount as a big criteria for decision, what other factors do you think investors need to keep in mind before getting into a PMS scheme? And also, in your opinion, if an investor wants to choose between a mutual fund or a portfolio management services, what are the factors they should also keep in mind?
Yeah, so the first factor has to be that the PMS which they want to get into, is it really differentiated compared to what offerings are there in mutual funds? Okay, so that is the first criteria one should have before entering into PMS. Or if someone really likes a particular portfolio manager in PMS who has a very long pedigree and has established a wonderful track record, that might be the case. Otherwise, the strategy has to be very differentiated, which you're not getting in a mutual fund. That should be the thing. But as I said, if you are getting into a PMS, your minimum time frame should be at least 3 to 5 years. And because switching in and out becomes very difficult. In a mutual fund, suppose if I invested into a mutual fund and I didn't like that fund manager or some changes happened, I can immediately withdraw or switch from that fund. Switching out from PMS may not be a very easy task. There may be heavy exit loads in the first year, second year, and stuff like that, because this is highly customized. So if you're getting into PMS, you have to make sure that it has to be minimum for 3 to 5 years.
Right. So before we move on to the next set of questions, to all the audience here, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. And in case if you have any questions, do put that as well, and we will take it up shortly. Moving on to some more interesting questions for Gajendra ji. You also mentioned that PMS has a very customized portfolio. Does it mean that the possibility of earning returns is higher in PMS schemes?
Yes, I mean, on paper, that logic has to work because if it is a far more customized portfolio compared to mutual fund, see, mutual fund has to follow all the guardrails prescribed by SEBI. They can't go, let's say, beyond 10% in a particular stock. They can't go beyond 25% in a particular sector unless it's a sector fund. So all these guardrails have to be followed very strictly in mutual funds. In PMS, there is no such system. I can have a 3-stock portfolio. I can have a 5-stock portfolio also. So PMS is supposed to be more customized, but that doesn't mean that the performance is guaranteed. Okay, the customization or the flexibility has its own advantages and disadvantages. If the portfolio manager's call goes wrong, then you will have the adverse impact, equally. So there is no guarantee that because it's a customized, it will give you high returns. And even data says, Sumana, for the last 10, 15 years, it has been a mixed performance, right? Because at the end of the day, the money is managed by that individual, right? Individuals,
Right.
fund managers can make mistakes, and they have made mistakes. So there's no guarantee. But if you've gone in for a very differentiated and customized scheme or a portfolio, then you should see over a period of 5-7 years how has that portfolio done. Not just one cycle, both good and bad cycle. And finally, you should compare with benchmark. What was the benchmark return? And also, then one should compare with mutual funds also. If there were similar mutual funds within that space, then how they have performed. If the performance is very similar, then it doesn't make sense to go with a PMS because PMS, comes with more higher charges, costs, and a lot of documentations and stuff like that. So unless there is a very clear difference in the performance between the two, I would say mutual funds can be a first preference.
Right. So while we see at one hand the possibility of earning returns could be higher, the documentation seems to be quite cumbersome. You also mentioned about charges, higher charges. What is the difference between the charges for mutual funds and PMS schemes, Gajendra? Would you want to highlight and share that with our audience?
Yes, Sumana. This is, in fact, a very big factor in deciding. As I said, mutual funds are very, very tightly regulated, so they have to follow the expense ratios in line with the regulations. And as the size of the mutual fund goes up, the expense ratios keep coming down. And it is same for all investors, right? This may not be the case in mutual funds because this is a personalized vehicle. What charges you are paying can be very different from what charges I may be paying, right? So you have to really understand what all costs go into a PMS. Though PMS is a complete transparent scheme because you can see exactly how much charges has been debited from your portfolio. There are all kind of reports which portfolio managers provide. Having said that, the charges are higher. In most of the diversified equity funds we have seen in the country today, they range from 1.5% for a regular plan I'm talking about, up to 2.25% generally. But in PMS, 70-80% of the portfolios that I have seen, the minimum expense ratio or the management fees itself is around 2.5%. Okay. And then you have other charges like custody charges, demat charges, audit fees, and all other things might add up to 3%. Right. So there is clear at least 1% difference between a mutual fund regular scheme and a PMS regular scheme. Of course, both PMS and mutual funds offer direct plans as well, which means if you don't need an advisor and you can select your own mutual fund or PMS, then you can go for the cheaper option there as well. But there is a difference of 1% between the two, and I mean you have to really see that is the fund manager able to generate that additional alpha compared to the charges they have they've been charging. If they're able to do it, then it is worth paying that 1% extra. But again, you have to see the long-term track record and then take a call whether you want to jump into PMS or not.
Absolutely. As you were discussing about the expenses, the point that was going on in my mind is it going to be impacting the overall returns from PMS, such high charges? Also, Gajendra, if you can highlight a little bit about the documentation, you said it's quite complex, at the time of investing. So what kind of documentations PMS schemes require vis-a-vis a mutual fund scheme?
Yeah, they're quite onerous. You'll have to kind of open a demat account and you have to undergo like 20, 30 signatures. Few PMSs have tried to manage it online, but it's still a very cumbersome process. Then you might have to sign power of attorneys as well, because you're giving the portfolio managers, the power to buy and sell stocks on your behalf. In some cases, you might need to open a separate bank account. So again, the bank account, is managed by them. You can't have access to that bank account, though it is in your name, but that's exclusively meant for running that PMS. So even opening, it can take around 10 to 15 days, Sumana, to open a PMS account versus 5 minutes in mutual funds. And like you have to have wet signatures in the demat form. So you need to be physically present, in India to do that. So there is a time lag, and same, if you want to tomorrow move away from that PMS, again, closure is not so easy. Plus the kind of compliance as a customer also you have to follow. You have to file all those reports in your tax system as well. So because fund managers buy and sell every now and then, there might be short-term capital gains, or long-term capital gains or losses, and you might have to pay these taxes every quarter, via advance tax, which is not there in mutual funds, because in mutual funds, while the fund manager may buy and sell on your behalf, unless you have redeemed from the fund, you have not paid a single tax to the government. So it's far more easier from compliance angle to manage a mutual fund portfolio compared to a PMS portfolio.
Right. I think, yes, one of the most important aspect of investing is also about the kind of taxes we pay on our capital gains, which you also highlighted clearly. So do you think for that matter, when it comes to tax efficiency for an equity investor, mutual funds could be a better way to invest?
100%, no doubt about that. As I already said, in PMS, every time the fund manager has sold a stock and there's a capital gain, you have to pay then and there, in the sense, in the next quarter, or so. In mutual funds, if I've not sold for 10 years, I've not paid a single tax. That's the first advantage. The
Right.
second advantage, Sumana, is that the dividends which you earn in a PMS, because your stocks are in your name, you would earn dividends. And these dividends are also taxed at the marginal rate in which the investors fall into. Whereas in mutual funds, because it's a trust, it's a vehicle, all the dividends come into the fund and is added into the NAV without tax. That's a great advantage. So if I'm in a 30% tax bracket or 35% tax bracket, I'm paying taxation on dividend every time I'm receiving it. While in mutual funds, I'm not paying that taxes at all. Deferring of taxes, which I said, if I'm withdrawing my money after 10 years in a mutual fund, I've deferred those taxation for 10 years. That itself adds to the power of compounding. Imagine paying 100 rupees to the government of India today and paying 100 rupees after 10 years. There's a big difference there, right?
Absolutely.
And the third and the final advantage which mutual fund has compared to PMS is, in mutual funds, the costs are reflected into NAV. And then when you sell, you are paying taxes post the expenses, which brings down your taxation. So suppose I've earned 100 rupees as profit in a stock, and there were 2% as management fees in a mutual fund. So my net profit is 98 rupees now, and I need to pay tax on that 98 rupees. Whereas in PMS, if my gain is 100 rupees, I have to pay tax on 100 rupees and not 98. And I have to pay the charges separately, that 2%, which is not adjusted against the capital gains. So this also adds, advantage to the mutual funds.
Absolutely. So in terms of taxes, it seems mutual funds are a clear winner,
Correct.
um, and very well established a point, Gajendra ji. Coming back to regulations, how well regulated are PMS schemes in India? We all know that mutual funds could be one of the most well regulated industry as far as financial products are concerned in India. How about PMS schemes in India? And is information readily available to the general public, just like we have for mutual funds? When we go through the mutual fund fact sheets, we know all about the fund. Does those documents exist for PMS schemes as well?
Yeah, so I remember in one of a session, the chairperson of SEBI were addressing the mutual fund CEOs, and they said like, "You are my elder children, you know, and elder children, no matter how well you do, I will always be kind of after you, all right? I'll never be happy with your work." So mutual funds are like that. They're like your elder child. You have to be very responsible. You can't afford to have any slightest of mistake because you're managing large pool of money and for the general public of the country. PMS by nature, as I mentioned, it's minimum 50 lakhs. So only high net worth individuals or very informed investors are coming there. And that is why there's a lot of flexibility there. And that is why the rules, SEBI has less onerous rules for PMS. Even if something goes wrong in PMS, uh, the, uh, SEBI doesn't really have to worry much because it was believed that the investors have understood the kind of the nuances of it. I remember there was one PMS in India 5 years back when in 2018-19 small cap had a big rout. That PMS portfolio manager had invested in very liquid small cap or micro cap stocks, and there was no exit. And the PMS manager had to write to the investors that, sorry, I'm not able to exit all these stocks. And that's why I'm winding up this thing. So the stocks are now credited in your portfolio. At any point of time in the future, if you are able to exit, you can do at your end. So the investors were left high and dry, but nobody, I mean, this never became a big news because, it wasn't affecting the large segment of public, right? If
Yes.
this would have been the case with a similar mutual fund, it would have become a big news item and front page headlines in media. And that is why SEBI as well as the industry, AMFI, has to make sure that they always are 2 steps ahead as far as compliance are concerned. Because imagine the money of a driver, maid, servant. I mean, every kind of person is
Definitely.
being invested. So we have to be more responsible. So SEBI will of course come very heavily if there is a lax in mutual fund, but that may not be the case in this thing. At the same time, mutual funds PMS also has to follow certain rules, and they now have their own association, APMI, Association of Portfolio Managers in India. They also try to now have the best practices. But still, as far as the data is concerned, mutual fund data is very easily available. It's very easy to compare from one mutual fund to another. In PMS, what happens, Sumna, because suppose you may be a PMS investor, I may be an investor, you and me both have entered at different levels. And because the portfolio returns are an average of all the investors' returns, you may not get what has been the true portfolio returns, over a period. So the data in PMS is not very easy to understand, and until earlier, some point of time, each fund managers in PMS were following their own kind of returns. Now of course SEBI has made it standardized, but still it's not that easy to get data. There are few PMS providers who collaborate all this data and give it, but to general public it may not be so easy to get this information.
Right. So it clearly seems that the risk-taking ability of a PMS investor has to be higher, with that kind of situation where suddenly there is a crunch of liquidity and you're not able to withdraw your money in spite of the fact that you might need it. So what has been your observation, Gajendra, in terms of behavioral and emotional aspects? How is a PMS investor different from a mutual fund investor? And is there a difference?
No, sure, it has to be because, as I said, mutual fund vehicle is for the first time investors. Once you have been into mutual funds for 4, 5, 7 years and you've created a decent corpus, I mean, I would say at least minimum 1 to 2 crore corpus, then maybe you want to try your hand into PMS to see how it works and what's the difference, if at all, it is there. And behaviorally also in mutual fund, as I said, for some reason, if you didn't like that scheme, you have an easy exit, right? But for PMS, you have to make sure that you're coming for 3 to 5 years minimum, and you have no choice but to be there. So only if you have created good 1 to 3 crore corpus, then maybe 50 lakhs, a part of your portfolio you can deploy into PMS and judge it over a period of time. But not early. I mean, if all you have 50 lakhs to invest, don't go with a PMS, because then you're putting all your money into one basket. And for whatever reason, if it doesn't work, then you'll have a very bad experience. win 50 lakhs in mutual funds, you can choose 5 fund managers, right? 10 lakhs you can give, and you can see how the overall portfolio does. But in PMS, you have no such choice.
Right. I think you have very well established some of the very important facts that as a new or a novice investor, one should keep in mind. The expenses are going to be higher for PMS. The ticket size is going to be higher. There may be lesser flexibility in terms of exit. Also, the risk profile, has to be higher. So I think that concludes very well why a mutual fund scheme clearly is something that a new or a novice investor should look at. So more or less, Gajendra, we do understand the key points, the key differences between PMS and mutual fund schemes, and I hope I could summarize some of the points. Is there anything else that you would want to add to the discussion to that could be of value for our investors? Some of the things that they should keep in mind before they choose the right schemes for themselves.
Yes, Sumana, I would certainly like to add here. See, it's not that PMS is a bad vehicle, or every vehicle has their pros and cons. Mutual funds has their pros and cons. PMS has their pros and cons. You need to understand, and you have to make sure that you understand all these risk factors very clearly before taking a call. I can tell you from my experience, 95% of my money is in mutual funds. 5% of my money is in couple of PMS schemes. So before making any judgment, I also want to try out and see, how that has performed. The schemes where I put in PMS are very differentiated, which you won't get this thing. See, one of the big advantage which a PMS can have is a performance linked incentive there, which is currently not in mutual funds. So, I have invested into a PMS product where I will only pay the fund manager after 3 years if the fund manager has beaten the benchmark, and there'll be profit sharing. Okay. Which means if my returns are 20% after 3 years per annum and benchmark has given 22%, though I made 20% returns, but the fund manager doesn't get anything because he has underperformed the benchmark. In mutual funds, whether the fund manager has outperformed, underperformed, the management fees still goes away, the TR is still charged and stuff like that. But in PMS, I won't pay. But suppose if the benchmark has given 20% return and my fund is, if benchmark has given 15% and the fund manager has given 20% return, the 5% alpha, there's a 50% profit sharing. Okay. So in that case, the portfolio manager has no choice but to make sure that at the end of the day, they have done their job for which they are hired to beat the benchmark. Okay. And generate alpha. And then they deserve to get that performance link incentive. So these kind of things can be possible in a PMS. It is not there in mutual funds. So I've been invested for last 3, 4, 5 years now. So far, in one PMS, of course, the results have been extremely well compared to mutual funds. But again, you have to see for a full cycle, because as I said, last 2, 3 years has been just one way up. So after a 5-year period, when I'm paying the fees, that time I should compare. Had I invested the same money in similar kind of a mutual fund, what would have been my net benefit compared to PMS? If PMS has outperformed by a decent margin, then by all means, we should continue to remain invested in the PMS.
Right. Gajendra ji, thanks so much for joining us today and sharing such valuable insights, which I'm surely is going to help our investors differentiate between a PMS scheme and a mutual fund scheme, and they will be able to judge and they will be able to figure out which is a good investment scheme for themselves. And I'm sure our viewers would have benefited a lot from your advice and expertise. To all the viewers here, if you need help managing your money, please click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Happy investing.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.